Era of the Fed Oracle is officially over. If you spent the last 5 years waiting for the Federal Reserve to tell you when to buy, when to sell, and what to expect next, you've been operating on a playbook that's currently being shredded in Washington. This week's FOMC meeting wasn't just another hold on interest rates, it was a regime change. Kevin Warsh has taken the podium and he's made one thing clear. The days of forward guidance, that crutch that markets use to build their entire risk-on mentality, are gone. Welcome back. Main Street meets Wall Street. I'm Marcus Dermott Sr. We're not here to guess. We're here to look at it. Today, we're going to do a deep dive into the 2026 economic landscape. We're going to play that clip that defines the new Kevin Warsh era, his first address, and then we're going to break down to see what it means for your money. We're living through this Hormuz paradox. We've seen it open, close. Now we're seeing bombs fly again. Blockades. We've seen the price of crude spike. We've seen it come back down. We've watched fertilizers and food supply chains get squeezed in real time. This is not transitory noise. This is structural. And it's hitting the American consumer right at the kitchen table. So we're going to jump from speculation to strategy. We're going to stress test those things just to think about what we're having in our home. This record U.S. sovereign debt, price to perfection tech market in our stock economy, and the current massive shift is maybe showing some underlying fragility. We're going to start right off with Kevin Warsh's full speech. Sit back, listen to what he says and what he doesn't say. Pay attention to the dot plots and know this is a different era coming in. I'm not saying it's good. I'm not saying it's bad. This is the information we need, Main Street, to help Main Street meets Wall Street. We're going to jump into the Warsh video.
Good day. It's an honor, a true honor, to be back at the Federal Reserve and to take up this duty at a time of such consequence. I've been especially heartened by the warm welcome of old friends and new colleagues both. And I've listened closely to my fellow FOMC members, heard a lot of new ideas, new thinking, and genuine interest in moving the Fed forward. This week's FOMC meeting exemplified the very best of the Fed's traditions: rigorous debate, open-mindedness, commitment to mission, responsibility, and accountability for performance. In this business, they all add up to one thing: getting monetary policy right, or as near to it as we can do. That is our North Star. My colleagues and I are here to serve our legislative remit, which you've heard us say before: price stability and maximum employment. And these objectives guided our business in the meeting just concluded. The appropriate federal funds rate to be at 3.8% at the end of this year, and 3.6 at the end of next. Let me turn now to a few words on a key initiative that we're announcing today. I'm appointing a task force in each of 5 areas that are central to the broad conduct of monetary policy. First, Fed communications. Second, the Fed's balance sheet. Third, our use and reliance on existing data sources. Fourth, productivity and jobs in an era of transformation. And last, inflation frameworks. These subjects are timely, consequential, and in my view, worthy of a fresh look. My colleagues and I discussed energy and purpose over the last couple of days. For each of these independent task forces, I'm enlisting some of the very best minds, both inside and outside the economics profession. They will be supported by subject matter specialists from our superb Fed staff. And they'll have a straightforward charge. Start with first principles. Ask hard questions. Examine current practice. Consider alternatives. And ultimately, propose next steps for policymaker consideration. Since last summer, my colleagues discuss possible improvements in the form and function of Fed communications. This new task force will build on that effort, and I expect propose some well-considered changes, including to the SEP I mentioned a few moments ago. The second task force, the one on balance sheet policy, will review the benefits and risks of the current ample reserves regime and the composition of the Fed's balance sheet. They will assess alternative frameworks for the conduct and operation of monetary policy. The third task force, the one on data, will evaluate new information sources and consider methodological changes to improve data gathering, with the aim of giving policymakers more accurate, relevant, contemporaneous, and perhaps most important, actionable information on the state of our economy. Fourth, task force on productivity and jobs. It'll survey the pace, the reach, the economic impact of new general purpose technologies, including AI, and explore the implications for the Fed in pursuit of our employment and inflation mandates. The last task force, the one on inflation frameworks, that'll examine the drivers of inflation, first principles, and weigh the full range of ideas for delivering price stability in a changing economy. You'll hear quite a bit about these task forces and this overall initiative in the coming weeks. Enough for now to make a simple statement. Each task force will serve an objective shared by everyone in the system, shared by everyone around that table that I sat with the last couple of days. A Federal Reserve that is clear-eyed about its mission, fit for purpose, and focused on the future. And with that, I appreciate your attention. I'm happy to take your questions.
Howard Schneider.
Once more with feeling. That was good. I think we got it.
Hi.
Oh, hey, dude. Wait, where's Esty?
I'm here. Okay.
Hi. Are you coming over?
I'm gonna need 20.
Okay.
Okay, I love you.
Love you.
Bye.
Oh, goodness. Where's my phone? Where's my phone? Where's my hand? Sorry. Oh, cute skirt. Thanks. You ready? Ready? Ready. Good? Yeah.
Hi, Chairman Howard Schneider with Reuters. Good to see you again, and welcome back. This is a lot to be putting in motion so fast. What is the timeline you have in mind for each of these?
So I think it'll depend on the task force. It also depends on the urgency in which we need clear answers. My expectation, I'm still in the business of recruiting and finalizing them. My expectation is the task forces will begin work in the next couple of weeks, and we'll start to get some more information from them, some more framing of how they see things starting in the fall, and hopefully most, if not all of them, concluding by year end.
And just specifically on the inflation framework, you talk about first principles. Does this include a review of the 2% target itself? You mentioned that things to the right of the decimal point don't matter. Should this be starting from a premise that 2% as a point estimate is too strict?
Let me break that into two pieces. First, on the inflation framework review, their remit is what are the drivers of inflation? What's the Fed's responsibility for inflation? In part, how do we measure inflation? But that'll overlap with my data group. On the 2% inflation objective, that is the Federal Reserve's long-held objective of 2%. You've heard me say before, I tend to focus on the left of the decimal point. Well, the 2 is the left of the decimal point. For now, 0 is to the right. I see no reason until we have reestablished our commitment and ability to deliver on the 2% inflation objective to revisit that outside the scope of what we're taking on.
Colby.
Thank you so much. Colby Swift from the New York Times. In the past said that inflation is a choice, and in the policy statement, it includes this pledge to deliver price stability, as you've reiterated today. But looking at the SEP, the bulk of your colleagues expect core PCE to run around 3.3% by year end, and for the 2%, inflation target not to be reached until 2028. So I'm curious how patient you think the Fed can afford to be at this juncture in terms of waiting for one-time inflation waves to wash through and for underlying inflation to step down after so many years of inflation running above target, and under what circumstances you would support the Fed taking some action and raising rates.
Sure. So quite a bit there. Let me try to break that into pieces. First, we have the capability and commitment to deliver on our price stability objective of 2%. That's exactly what we're going to do.
I grew up working on this farm. Friday was football. Sunday was church. We looked out for each other. Go after insurance companies denying you treatment, ripping you off. It's time to get it done.
For 125 years, the people of Firestone have been building products and services with one thing in mind, to make sure
that in the Fed's review of its strategy over the last any number of years, in January, the Fed, including the strategy that we're still bound by, the Fed statement says that inflation is primarily determined by monetary policy. You bet it is. I've said for years, inflation is a choice. You bet it is. And today I'm announcing that this committee unambiguously and unanimously have decided we are going to deliver on that. The rest of your questions sounded like an encouragement for me to give forward guidance. We've dropped forward guidance. Some along the committee, I think, dropped it, I suspect, from our discussion the last couple of days, because they said at this moment in time, it doesn't feel as though providing forward guidance is right. Others have, I'd say, different views and think as a general proposition, forward guidance isn't the business we should be in, but that'll be taken up by the task force on communications and my policymaker colleagues. We're gonna listen hard to what the experts say and make our own decision. But I can't give any forward guidance about what we're gonna do next. The good news is we'll be meeting in 6 weeks.
So just following up, I guess, on the current policy settings, then I am curious how restrictive you think things are at the current moment, given the flow of data that we've seen and forecasts that are coming down the pipeline.
Yeah, I've heard characterizations both inside and the Fed about. Give you my own. It's uneven. If I look at the housing markets as one example, Fed policy isn't the single determinant of the state of the housing market, but broadly, I would say Fed policy appears to be somewhat restrictive. I would have a hard time managing to say those words if I were to see what's happening in financial markets. So I'd say it's uneven. That's perhaps a function of different transmission mechanisms of monetary policy, whether monetary policy is coming from our interest rate tool or our balance sheet tool. But the good news, we have a task force on that too, and the balance sheet task force will be looking more at that subject.
You've said you don't like forward guidance. You dropped it from the statement this time, but with the dot plot, 9 members suggested that they want a rate increase by the end of the year, and the markets have taken that as forward guidance. So what does this mean in terms of how you guide the markets and in terms of...
I grew up working on this farm. Friday was football. Sunday was church. We looked out for each other. So I'll go after insurance companies denying you treatment, ripping you off. It's time to get it done.
Sometimes their timing can be a bit rough. That's why Urgent Vet offers after-hours pet care open every single day. Get answers and get back to life. Urgent Vet, your pet can't wait to feel better.
what the dot plot's future is.
I'm going to have to give you the same answer I gave to Ms. Smith. We've got a task force for that. I'll give you a little bit more. I reviewed the dot plots, and when I saw the submissions, I noted that all the submissions were coming in with pencils, you know, those kind with the big erasers. That's to say that I think my colleagues around the table, when they submitted their dots, understand the world is changing quite quickly. And they didn't feel bound by them 6 weeks from now or 6 days from now, in the event that their circumstances change. I'll note a couple other things. What I heard around the table was as they submitted their modal forecasts, to be clear, weren't this was more likely than not. This was more likely than their other scenarios. So I didn't hear tons of conviction. What I heard was the kind of humility that I think we should have. I did not submit a dot. For me, it's not helpful in the conduct of policy. I suspect by year end, as I mentioned in my opening statements, there'll be a review about communications broadly, press conferences, dots, meetings and the like, transcripts, minutes. This will be part of that. I don't want to prejudge the outcomes there, but I'm pretty open-minded about what they could be. And I was just incredibly impressed over the last couple of days. My colleagues over the last 2 days, and frankly, over the first 3 weeks I've been here, they've been very open about changes. Change isn't easy, change is filled with risk, but our number one goal is to get monetary policy right. The way to get monetary policy right is to deliver on the remit that Congress gave us, to deliver on price stability. And there was no disagreement on any of those points.
At the risk of possibly getting the same answer about task forces, communications, what is your feeling about these news conferences? Are you going to continue one after every meeting? Do you find them useful? What is the future for the way Kevin Warsh will communicate?
Well, this one's probably got another 15 or 20 minutes in it, so I don't want to prejudge the outcome. Press conferences can be a very useful way to communicate with households, businesses, and more broadly through using the likes of you. I had a great old mentor named George Schultz, and his mantra was press conferences are useful, but when you have one, you want to make sure you have something important to say. Today, I think we had something important to say about our commitment to deliver on price stability, our commitment to rethink practices with an eye of moving the Fed forward, and to give you and the American people a sense that these aren't idle thoughts, these are concrete thoughts, that we're going to seek out the best minds, both the best thinking inside of the Federal Reserve, and the best people I know in business and economics and the academy and technology and the rest, to share their views. That's what we're going to be doing here, the pursuit of truth. I think we're going to come up with some new and interesting things. We made some changes today. I expect more changes to come. And some of those might well be worthy of a press conference.
Chris, your favorite.
I grew up working on this farm. Friday was football. Sunday was church. We looked out for each other. So I'll go after insurance companies denying you treatment and ripping you off. It's time to get it done.
For 125 years, the people of Firestone have been building products and services with one thing in mind: to make sure you get to where you need to be.
Hi, Chris Rugaber at Associated Press. Thanks for taking our questions. Could you give us a sense of how you see inflation more in the long term? I know you may not want to comment on the ups and downs, but is this mainly driven by energy prices in the Iran war at this point, or do you have any concerns about underlying inflation pressures in the economy? Thank you.
So I can't do much better than the committee just did. So let me restate it. Inflation remains elevated relative to the committee's 2% goal, in part reflecting supply shocks that have driven price increases in certain sectors, including energy. The paragraph goes on to say, but to be clear, the Fed will deliver price stability. My own judgment is the committee spent quite a bit of time, not just in 2 days, but over iterations of a couple of weeks. That's what we're prepared to say about inflation, but the commitment to deliver is strong, unanimous, and unambiguous. And that's, I think, an important message. We've missed for 5 years, and we're going to fix that.
Well, great. And then just on the data task force and everything else, I mean, generally speaking, I think people feel the Fed looks at everything already. Certainly that was the sense from before. Is there data that you feel is not given enough weight? I mean, you mentioned the trim to mean in the past, but again, that's well known to certainly most Fed members. So what is that task force looking at, and what might be I mean, I know you don't want to prejudge the outcome, but are there examples of data that you expect might be given more weight? Thank you.
So you're answering my question. So let me say, I don't want to prejudge the outcome. I also don't want to say too much about what they're going to do because I still have a phone call or two to make before I've nailed down the people that are doing that. I'm interested in what the outside experts' view is on the subject. I'll say this generally. Most of the data that central bankers and other government officials in the United States consume come with old-fashioned survey methods, a national accounts of what the U.S. economy looks like that looks very little like the U.S. economy in 2026. Survey methods that don't have response rates that we need, asking questions that might have been quite applicable a generation ago that are less applicable now. So even inside of official statistics, I would be open-minded if the task force and our own best thinking had recommendations how those official statistics can be brought up to a standard of our time using new analytic methods. I'd also say this, almost every private company CEO that's running his or her business are doing so with real-time information that isn't subject to much revision, that is telling them what just happened at that very moment. As you know, there are normal, long and variable lags in the conduct of monetary policy. What we're really interested in is what's happening right now. What we're less interested in is echoes of history. And you're hearing from my answer that some of the data that we receive, that we're waiting on, the first Friday after the month, the payroll index or something else, that might be an echo of history that's quite useful on its third revision. We need to take those error bounds down because we have to make hard decisions in real time. I'm really open-minded that there is a lot of new data sources that we can learn from the private sector, from reforms in the official sector, and new analytic techniques that are far more refined than asking a simple question about whether something was core or non-core.
A new era of American shipbuilding is here. When you hate your job, you get bored. When you're bored, you shop online. When you shop online, you buy taxidermy squirrels. When you buy taxidermy squirrels, hacks happen. When hacks happen,
What the
your data gets leaked. When your data gets leaked, Ron steals your identity. When Ron steals your identity, he takes everything. Don't let Ron take your taxidermy. Protect your identity with Cloaked.
Thanks. Welcome, Mr. Chairman. Edward Lawrence with Fox Business. So if you don't give a lot of ongoing forward guidance, won't the markets have more volatility? And shouldn't Americans have more access into what you're thinking going forward?
So I think financial markets perform best when they react to incoming data. I think the financial markets work less efficiently when they ask a question, how will the Federal Reserve react to that incoming information? The more that markets are paying attention to what's happening in the real economy, deciding what's good data and what's less good data, the more financial markets can price what they believe is the most likely and what are the tail risks. Financial market prices are probably the most important source of information to guide central bankers. But when all the financial markets are doing is reflecting back what we've said, then we're taking the most important source of information and we're being blind to it. I'd like us to create a system where those blinders come off, where markets are following data that they efficiently think is reliable, and they'll be watching data, we'll be watching data. They'll come with better information through market prices to us. We can make more informed decisions. But ultimately, the goal that I said at the outset, deliver on the price stability objective that Congress told us to do, and that we've got to get in the business of doing.
Yeah, if I could take you in the meeting a little bit. This is your first meeting. The board members seem fairly hawkish when you listen to, in general, when you listen to what they're saying. Was there any discussion of a rate cut going forward today?
There was one proposal on the table. There was no discussion of any other proposals. The discussion on that proposal, I would say, was quite limited. The group was unanimous and unambiguous on it. It has been the practice of this central bank and others to have a range of alternatives. Today we had one. I thought it furthered the discussion, deepened it, and made it clear what we needed to do and how we needed to deliver. I wouldn't prejudge what happens in the future, but there was only one big subject for us. We took it on. We had a good family fight on it for a couple of days, and we ended up, I think, in a better place.
Claire.
I grew up working on this farm. We looked out for each other. So I'll go after insurance companies ripping you off.
For the moments that can't wait, but don't need the emergency vet, Urgent Vet is here.
I'm so glad we came here instead of the emergency vet.
It's urgent, but it's not life-threatening. That's what we're here for.
Urgent Vet.
Thanks a lot, Claire Jones, Financial Times. Coming to this blind, reading this very nice short statement that I think we've all appreciated in the room, one might wonder why you didn't raise rates today, considering what you're saying here about the risks to US inflation and your mandate. I guess, why not, and what would you need to see in order to get to that place? And secondly, on your task forces, are there any best practices at other central banks that you'd consider looking at? Thank you.
Yeah. I'm glad they're in the practice of giving you two questions, because my answer to your first question was to be very curt. I've got nothing more to say than the statement itself. And to the point of the question I got before, market reactions to what we say unfiltered, I think is more helpful than having delivered a statement, me then improvising further upon it. Best practices of task forces. This is a subject I've thought some about. I've been on a task force or two in my life. Best practice, find the best minds. Ensure that the task forces have a range of people, both by backgrounds and predispositions, so they too can have a bit of a family fight. Make sure when you establish a task force that the group that's going to be the recipient of the information feels as though they've got some equities in it too. That's why we're looking for, haven't done the final roll call, some of the most significant talent we have in the building and across the reserve banks on each of these, and in some sense seconding them to this group for a period of some number of months, so that the leaders of the task force know what the most analytical central bank in the world thinks about that. They can reflect on it. And a final best practice, we're not outsourcing decisions to anybody. Administrations past and present, reserve banks have chosen a group of 19 people around the table. These will be our decisions. We can agree to some of the recommendations, disagree with others, have a good family fight about it. But what comes from them will, I hope and believe, make the discussion we have internally better, stronger, more of a dialectic, so that we can finally deliver on that price stability objective.
Just a quick follow-up on your markets point. If you look at 2-year yields, they're really suggesting that markets think more tightening is needed. Would that be your read on what the 2-year yield is saying as well?
We were in such a good place. This is why we don't do third questions, I presume. I'm not going to offer any commentary on market reaction over the last 30 or 60 minutes. What we've given markets is a new chapter for the central bank, some fresh thinking. What we've given markets and households and businesses, I think, is a commitment to ask ourselves hard questions such that we can deliver on the promises that we've made before. This is a lot of change for financial markets to digest. I wouldn't be particularly intrigued by how they react in the first several minutes or even first several days. What I think is most important is that financial markets, and at least as important, households and businesses know that this central bank will deliver on price stability.
Brian.
I grew up working on this farm. Friday was football. Sunday was church. We looked out for each other. So I'll go after insurance companies denying you treatment and ripping you off. It's time to get it done.
Yes, we know it's political season with all these
Brian
ads.
Chung with NBC News. Thank you for taking our questions. So when you say that we've dropped forward guidance for the layperson, that might sound like the Fed's going to say less or offer less insight into where their borrowing costs might go. So for the person that maybe you might run into at the grocery store where the price tags are rising at a faster pace than their wages at the moment, how would you explain it to them? I don't know if task force might be the answer there, but how would you kind of communicate this era, this chapter of the Fed?
If I told somebody in the milk aisle that I had a task force for that, I think that would be doing a very poor job. So I appreciate it. If I saw somebody in the grocery store, what I would say to them is that we cannot have a very significant effect on particular prices. The price of oil in the markets today, or even the price of a dozen eggs, that does not have first order consequences to what we're doing. But we do have a really important job there. And it's to make sure that those changes in oil or beef or eggs or milk don't broaden in the economy, don't have second and third order effects. That's our job. That's our commitment. That's our capability. And we're going to deliver on it.
And then is the Fed's relationship with the Treasury also under review? There was the normal breakfast meetings with the Treasury Secretary. Is that something you intend to continue doing? And have you had conversations with the president since you're swearing in?
So on the president, I don't have anything for you. With respect to the Treasury Secretary, he has been posting pictures of our breakfast. So I don't think I can deny that. The long tradition at the central bank is that the Fed chairman and the Treasury Secretary meet weekly. I think we've pulled off 3 of those so far. I believe he's overseas this week, so this will be the exception to the rule. I think they're very useful discussions. The central bank's objectives and our roles and responsibilities are quite delineated from the fiscal authorities. And in my view, monetary policy is independent in the conduct of what we do. But that doesn't mean we're not interested in what's happening with the fiscal authorities. The way I think about it is this central bank needs to have a wide lens, but a narrow remit. We need to be quite interested in what's happening in the world. I won't be breaking any news here to suggest I'm quite interested in what's happening in the Middle East. That does have some effect on our day job. It doesn't mean it's our responsibility, but I think we're going to keep a wide lens, and my meetings with Secretary Besson to this point have helped widen that aperture. So we're aware of things that could affect our day job, even if it isn't.
Steve? Every day I find people to talk to. I didn't have that at home. That's the value of holiday.
Fans pay more attention than me when I hear my own song come on. Imagine advertising to that audience.
Steve Leisman, CNBC. Mr. Chair, thank you, Mr. Chairman. Thank you for taking my question. You had said in the before you became chairman that you thought productivity was a reason why the Federal Reserve could lower interest rates. Do you still believe that to be the case?
So the committee had a discussion of productivity today. AI came up. The way I thought about it before and socialized with the group is that artificial intelligence, the latest generation of general purpose technology, is perhaps as important a change in the economy and business and households that we've had in my adult lifetime. It is filled with both a huge opportunity and with risks. I take both of those very seriously. You may have heard me say before that AI is shorthand perhaps for American ingenuity. That doesn't mean that it's going to be easy. That certainly doesn't mean it's not going to be disruptive. But over the long term, my conviction, and I heard quite a bit of support for this around the committee today, is the United States is a winner as we go down this. The United States is ultimately going to be better off in that. Now, to bring that back to the conduct of policy, timing, scale, speed, implications for output and employment, it's one of the things we have a task force to do.
If you don't mind, a follow-up from the other side, which is that when you look at the strong job growth that's out there, the elevated inflation, GDP seems to be going pretty good, and the stock market seems to be soaring. Do you look around this economy and see the funds rate being restrictive?
So that's your second question. I'm going to give the same answer that I gave before. I'd say as I think about the conduct of policy, what matters is what's the effect of policy. Not what do we say, but what happens. And the best way I can describe it is it's uneven. I do see some restrictiveness in things like housing. It's hard to use those same words anywhere else. I'll just make one other point. You talked about one of our dual mandates in the employment side. I don't believe that we have a cruel choice. I don't share the view that was expressed a few generations ago that Federal Reserve chairmen show up at a podium like this and say, you got to choose. And you're going to have to decide whether you're willing to tolerate.
I grew up working on this farm. We looked out for each other. So I'll go after insurance companies ripping you off.
For 125 years, the people of Firestone have been building products and services with one thing in mind, to make sure you
higher inflation to put more people at work. I don't believe in that. What I believe is if we do our job, we can make strong growth, low prices, and strong employment mutually compatible. And so what you heard from the committee today is we've got some work to do on the price stability front.
Nick.
Thank you, Nick Timmeros with Wall Street Journal. Chairman Warsh, you've said repeatedly credibility is earned by delivering. If credibility requires delivering, the move would be to tighten or at least to threaten to. Now, you didn't do that today. Why not?
That judgment you expressed was not expressed by any of the 19 people around the table. We'll be meeting in 6 weeks. We'll take up the issue again.
And if I could ask about AI, the build out is generating enormous demand right now, CapEx, data centers, power. The productivity payoff may be further out. So in your judgment today, is AI adding more to demand or to supply?
It's a good question. At the central bank in an economics profession, what we spend most of our time doing is counting demand. It's easier. We can see it, we can count it, we can check it, we can revise it. What we do, though, is we infer supply. You'll notice in the second paragraph of what one of your colleagues described as a very short statement, we have a sentence on the demand side and a sentence about the same length on the supply side. They're both important. Just because we can count one better than the other doesn't mean we're going to favor one more than the other. With respect to AI and the growth of data centers and infrastructure around it, we're counting the demand side, and it is no doubt showing up in GDP figures. We can be less certain when we infer the timing and extent of the growth in the supply side. It may well be an intuition the supply side is going to expand, but it'll take longer. And just describe it this way. There's a race between supply and demand. Milton Friedman says that the only thing we know about economics is that there's a supply line and a demand line they ultimately cross. When they cross and what are the implications for policy? The good news for you is we have a task force for that.
Andrew.
Thanks, Mr. Chairman.
I grew up working on this farm. Friday was football. Sunday was church. We looked out for each other. So I'll go after insurance companies denying you treatment and ripping you off. It's time to get it done.
A new era of American shipbuilding is here.
It sounded like on the task force on data that you were looking at overhauling or completely overhauling the system of national accounts, the way the government mines the economy. Is that your ambition?
In a word, no. In a few words, much of this data gathering happens in other government agencies to which we owe a tremendous amount of respect, tremendous amount of deference. But if in the course of this, we come up with recommendations, which Fed staff have already begun to develop about things that they could be doing to help inform us as policymakers, we're not going to hesitate. Again, I don't want to try to delineate the four corners of the research of the task force on data, but I do think there will be a review of official statistics, and at least as important, a view of bringing the best practices from the private sector and new analytical tools made possible by AI so we can forge these into a fabric that gives us better real-time information. So as I mentioned before, when we're making decisions that we'd say are real contemporaneous data, not data that we call contemporaneous, that's really an echo of history.
Okay. Thanks. The other question I wanted to ask is related to the building renovations. Are you considering any changes to the renovations, the projects, just in light of the fact that they became kind of a political football in the last year?
I heard something about that. I don't think I'm breaking any news, but my view, when you show up at a new institution, you should go meet with the Inspector General, just as a matter of good practice. It's a practice that I hope to continue. I've had one meeting with the Inspector General, and he told me what I believe the world knows, which he'll be coming out with a report on the building and the building projects at some point later this summer. I'll be interested in reading the report. From my perspective, with a forward-looking glance, is there anything that we can be doing or should be doing from this moment until the completion of the project to do what we can to be good stewards of taxpayer money and to make sure that we're delivering on the promises that we made? Some more work to do. You might not be surprised in the first few weeks. I've been somewhat preoccupied on other matters, but I promised to get to the full breadth of the Fed's tasks in the weeks ahead.
Victoria.
I grew up working on this farm. Friday was football. Sunday was church. We looked out for each other. So I'll go after insurance companies denying you treatment and ripping you off. It's time to get it done.
Hi, Victoria Guida with Politico. So I know that you did not submit a forecast, but you are the person who is authorized to speak on behalf of the FOMC. So I'm wondering if you could tell us in the SEP, the increase in the expectations for inflation, is that all because of the Iran war? What was the discussion around what would the expectations for inflation being higher and also potentially growth being slower?
So my read of what I heard in the room reflected, I must admit, in the SEPs, is half of my colleagues thought the policy rate, given all those developments, should be at this level or lower between now and year end, and the other half thought higher. That 19th voter was me, and I didn't submit one. There's a range of views on the questions of first and second round effects, no resolution or conviction, but we'll be meeting again in 6 weeks. I think we're going to know more then. And I think that my colleagues are very attentive to incoming developments between now and then.
And can I just quick follow up on the SEP? You said that you're still encouraging your fellow committee members to submit forecasts even if you're not doing it. So what do you think is the benefit of them doing it even if you don't?
That's the commitment that the FOMC made, and it's a commitment that I hope we live up to. Commitment we made was to deliver price stability. I expect us to live up to it. By the time we get to the end of this year, as I mentioned, I wouldn't be surprised if there was a new communications framework, there were some changes to the SEP. That's a committee discussion, a robust discussion. I think we'll have it. I believe we're going to come to a better mix of communications to deliver on what we promised, but I wouldn't want to prejudge what those are. But between now and then, I would continue to expect colleagues to submit their SEPs. Some of them, I think, believe that the practice is currently structured is okay, but I heard a lot of interest in real reform, generally about all these topics. You didn't ask it, but I'll answer. It was a pretty gracious couple of days, and it's been a pretty warm few weeks.
I grew up working on this farm. We looked out for each other. So I'll go after insurance companies ripping you off.
Yeah, turns out it's non-melanoma skin cancer. And my doctor says most surgery is my only option.
The institution wants to figure out how we can do better. The institution's going back to first principles. And I'm encouraged that what we've done in the statement, what we're thinking about doing with respect to the SEP, that instinct towards a new chapter is a real one. And by the end of the year, I hope we can put some points on the board, both in form and in substance of delivering.
Going to end up for the last question.
Thank you, Mr. Chairman. Andy Curran, Bloomberg News. Could you guide us through, please, some of the principles that guide your own reaction function, and tell us a little bit about the kind of conditions that you think when the Fed should respond?
It's going to be a very unsatisfactory answer to the final question. The Federal Reserve has a lot of responsibilities, not just in monetary policy, but in supervision and regulation, consumer affairs and payments. My own view is our credibility comes from delivering on what we're saying we're going to do across everything we do. I've devoted more time in my first 3 weeks to monetary policy than all those things. But the more we deliver on our promises as good supervisors and good regulators, the more benefit we get, the more credibility enhancement we have in monetary policy. When we deliver on our price stability objectives, which we will, the American people, as though the hardships that they've been living through in part because of inflation the last 5 years are in the rear view mirror, and that credibility will have dividends across what we do, and the institution will come to press conferences like this, always with an impetus to reform, always with an impetus to do better, but we're going to put some points on the board.
Mr. Chairman, that's on labour data in recent months. How would you sum up the labour market right now? Do you see it as stable and as potentially a source of inflation? Thank you.
Yeah, so the committee, if I were to try to capture how the committee thought about it, the committee thought that the labor markets were stable. There were some people around the committee who thought that it was trending better than that. Trends matter more than data points. What's happening over 3 or 6 months matters more than any one data point, any one data release. And I'd say the jobs data has been moving in a good direction. If I heard one other thing around that subject over the course of the last couple of days, what I heard was that strong productivity-led growth is not something that we fear, but something we embrace. Thank you all very much.
And there you have it, straight from Kevin Warsh's mouth. It's the first week of Warsh's speech. SpaceX at IPO's first full week of trading. Kevin Warsh didn't just change the post-meeting statement. He launched a quiet revolution inside the central bank to fundamentally rebuild the Federal Reserve from first principles. Warsh announced 5 independent task forces. These aren't standard committees. They're a mixed group of internal Fed staffers and external experts tasked with tearing down and rebuilding how the Fed operates. Are they going to have strict deadlines to deliver a complete strategic framework by the end of 2026? That's the goal. But this isn't a slow transition. It's a corporate-style restructuring of the world's most powerful economic institution. Let's take a second just to think about some of the areas that Chairman Warsh introduced. Fed communications is one of the task force. So the first and most immediate goal is Fed communication. For years, the market hung on every syllable of Fed's forward guidance. Warsh wants that dead. This task force is reviewing whether to permanently scrap the famously quarterly dot plot, which Warsh did not participate in, and eliminate routine post-meeting press conferences entirely. The philosophy here is profound. Warsh believes that by telling the markets exactly what the Fed will do, the Fed accidentally blinds itself. If the Fed stops guiding the market prices will finally reflect true economic reality again, serving as an unmanipulated data feed back to the central bank. So he's pushing the onus from the bank to send a signal, and the bank is now receiving a signal from the market, I guess is a better way of saying that, right? He also pushes on how the Fed uses backwards-looking data, lagging data. So that's one of the task force. Next, he's focusing on the Fed balance sheet. The Fed's multi-trillion-dollar balance sheet. Over the last 2 decades, the central bank became the world's largest buyer of bonds. The second task force is conducting an aggressive top-to-bottom audit of asset management. Because this study is locked into a year-long timeline running through late 2026, it sends a massive signal to Wall Street. Don't expect any sudden near-term changes to the Fed's bond portfolio, although Warsh has started making moves to reduce it. Any structural shifts are a long way away, giving the market a predictable, quiet runway while the deep work happens behind closed doors. Third task force, or another task force, tracks a flaw that has plagued the Fed for years: lagging data. The central bank has historically relied on backwards-looking macro indicators to make real-time policy choices. Warsh's data task force is reassuring the Fed's entire information pipeline. They're auditing whether traditional metrics are still accurately capturing the speed of modern economies, or if the Fed needs to build entirely new high-frequency data pipelines to avoid driving the economy looking strictly through the rearview mirror. AI productivity and inflation. So the last two task forces prepare the Fed for a radically different future. One focuses on productivity and jobs in the transformative era and specifically built to study how artificial intelligence and automation are how artificial intelligence and automation are altering the labor market. Warsh recognizes that AI could massively spike productivity while shifting employment dramatically, throwing out old Fed models out the window. Meanwhile, Task Force 5 is reevaluating the inflation framework. It's examining whether the Fed's legacy tools are actually effective at maintaining absolute price stability, and in the new tech-driven era, ensuring the Fed isn't fighting tomorrow's inflation with yesterday's playbook. Another thing to note is that new Chairman Warsh only focused on one side. He's focused on price stability a lot, not so much on labor participation. He mentioned a lot or several times that his focus is on the left side of the decimal. When he says that, means he's focused on that number 2, 3, 4, whatever the headline. I shouldn't say headline because that's a different type of inflation. But whatever the number is, whether it's headline or core inflation, whether it's 2, 3, or 4, not so much on the numbers after that decimal point, which people often should count as well. I mean, that's a big percentage if you take that whole percentage out. But he's also just showing his shift in the way the Fed is looking and the Fed is moving. So one thing about it, two things for sure. Kevin Warsh came in and put his stamp on this Fed. He put his name there. He put his initiatives there. Two things about it, though, is this is still a committee. So there are a lot of different groups and ideologies inside this Fed. The Fed is also elected. They're not elected, they're appointed, but they're appointed by officials who are elected by the people. It was interesting, all of the political campaigns that played in that video from Fox Business that were for a Democrat, Roy Cooper. They did target it right, though, because I was in North Carolina, so they targeted the right area. But it's interesting, there weren't any other videos. It was all from one side, and it was on a different network. So I don't know, but it's that time of year again where political ads are coming out. So the inflation target is a big thing that we should think about as well. Inflation hinges a lot where we are, where prices go, cost of living when it comes to that later, and the cost of living adjustment later in the year. It's based on PC, I believe, if I remember correctly. Personal consumer expenditures index, that type of inflation. But the 2% target that he mentioned, and that may not be 2.0, it might be 2 point whatever, what he pointed to on the other side of ledger. And you could see, actually, if the price of oil comes down with the war from where it was versus months ago, you could see an inflation target or an inflation number come out with one of these reports a few months out with a 2 at the front of it or a low 3. We've seen some high 2s, but it's just the Fed has stated this goal for 5 years of 2% inflation. They really haven't met it. But Warsh said they were unanimous in their decisions on the board that they can reach that goal and that they wouldn't change the goal. That was one of the things that perhaps we didn't know if he would come in and change the goal, change the Fed target for where they are trying to reach. Maybe raise it up to 3% with this increased productivity, this increased GDP expectations. This is from America. The world GDP, the International Monetary Fund lowered global GDP expectations down a little bit here recently, but there's a detox going on, so we'll see if this new productivity, we need wage growth to catch up to inflation. That's a big thing that's hurting consumers right now, is wage growth is not catching up or holding pace with the consumer. So what you see inside of that is a struggle to purchase. You see your purchasing power actually decreasing every day you see it going down. But we've seen prices at the pump come down here recently. We've seen prices at the pump come down. We've seen some food prices come down. We've seen inflation. Inflation's sticky though. We saw a 6 handle last inflation print. That's a big number that can be scary when you're looking at it, but that wasn't totally unexpected given that oil and gas prices, when the war started, that data is just starting to feed through, were in the high 60s and they doubled pretty much. So you got to think about that when it plays into inflation. Inflation almost doubled. There are a lot of things that go into oil, You have fertilizer, that's a big thing, which plays into food, and it just plays all through the supply chain, the increased cost of transporting goods. And we saw that 6 handle on the producer price index. So we see that it's being passed on to the producers, the consumer. The CPI was lower, consumer price index. So that means it hasn't been passed on consumers yet as high. It'll be interesting to see what this recent reading comes up to say. Because inside of that, we'll see if more of this pricing pressure has been passed on to the consumer, or if the producer is still absorbing most of it, or if we just see some of this inflation is leaving at this point. I don't know. Inflation's sticky, and that's one of the things they're focusing on over there with Chairman Warsh is the inflation. We saw a struggle it's not a struggle. We saw that employment was still strong, above expectations, employment and job growth with the last numbers that we saw come out. So inflation seems to be a sticking point for Chairman Warsh. Like I said, he didn't even really mention the other side of the dual mandate. A big thing that he always also mentioned, not always, but a big thing that he also mentioned was the fact that the Fed is probably going to reduce forward guidance. I mean, he definitely wants less Fed speak. But I don't know if he realizes, like, if he reduces forward guidance, and this is just thinking out loud, if he reduces forward guidance and the amount of time that the Fed speak, that the words that they do say will have far more impact on moving the markets. He can't restrict the governors from speaking. He can try to influence them to speak less, but they're all independent governors of their own banks, so in their districts, so they can speak. It's just he's trying to reduce the level of communications, as I mentioned earlier, because he wants the markets to move on market structures and pricing, earnings, costs, versus what the Fed is saying, where the Fed's chasing. The markets have been chasing 2% inflation targets and sending their expectation of 2% inflation targets. And the Fed clearly has been not able to reach that goal. Although it would be hard to say that Jerome Powell did not pull off a soft landing. It's left to be seen, but we'll see. He flew up into some bumpy turbulence when inflation was at 40-year highs, but we'll see how history plays out with that. Also notice that Jerome Powell is still on that board and still a voting member, if I remember correctly. So they're moving away from the dot plot. So those are just economic forecasts from each Fed governor. They put them on a chart, a literal plot, dot on a plot chart. So Warsh wants to do away with that. All the other governors voted. I think there were 9 and 9. He did not vote. 9 whether to lower inflation or raise inflation in the future, where they saw inflation heading. He did not vote. He would have been the deciding vote. I don't think it would have changed anything. They all decided to keep inflation or keep rates paused. They weren't raising or hiking inflation. He said that in 6 weeks they'll have a lot more information, a lot more data. I guess he's getting these task force going. Some of the things that to note with the task force, he mentioned he was looking for strong minds, experts. He's looking for diverse opinions, people who can have, he kept mentioning family arguments, strong family disagreements. So he's looking for some consternation inside these areas but good consternation, good, healthy conflict and verbose discussions hopefully will come from this. And hopefully all this benefits the American people. This is Warsh's first meeting, so we have to give him the benefit of the doubt. I mean, President Trump spoke but President Trump has a lot going on with the war right now. We had the peace agreement that was signed, the memorandum, but bombs have started flying again since then, or missiles or something. They've started shooting again at each other over there. We've started engaging things. I think the Strait of Hormuz has been blocked again. So we saw some traffic coming out of there. It'll be interesting to see where that leads with the economy and data going forward. And we'll see what Monday and the rest of the week looks like, but it could be a bumpy one going ahead, which is a thing that you should note also historically, and I digress a bit, but that the markets, and I've said this before, the markets will probably be choppy and volatile going up into the midterms. And this is historical, and then once you get to the midterms, we have a little clarity into who the elected officials are into the end of the year, even into the beginning of next year. We should see the markets explode up and back to the right. Hopefully too much damage has not been done until that time. I mean, we have to remember markets are all-time highs. But another thing to note is that when Chairman Warsh spoke on Wednesday, I think the market had the largest decrease ever after the first chairman's meeting ever. But like he said, he's not really watching what the market's doing in the first few 30 minutes, hours, or even days after he makes his speech. He understands. Another thing to know is that Fed chairmen are usually tested. So they're usually tested by the markets or some abnormal event. Chairman Powell, when he came in, that was right around when COVID hit, so that was one of his tests. I think if you go back to the 80s, we had the Wall Street crash, but that was all set up from running the economy hot, a lot of productivity, growth, and gains. That was also a K-shaped economy like we're seeing right now. So a lot of parallels to when the 80s took off to when the 2000 or the 90s to the 2000 boom took off, the dot-com boom. So there's a lot going on. Are we on a 17-year bull run that started at the end of the 2008 market crash? That's to be seen. There are people who think that this market is about to pop and the bubble's going to blow anytime, and there are people who think this thing can continue to grow until the end of the year or to the end of the decade. So you just have to be positioned, know where you're at. Don't jump out of the market right now or anything, because you would have missed a ton of gains if you jumped out of the market. You have to stay invested in the market. You just have to know if you want to be more risk on, and if you want to have more exposure to stocks, or if you want to be a little bit safer, but you need some exposure to stocks, because historically stocks are one of the few things that have beaten inflation, like price participation. So when I say like your cash is literally losing money and losing productivity, think about the example here where we're talking about inflation and inflation target, or people who are on fixed expenses from like COLA adjustment, cost of living adjustments that you get. We're set last year, I believe, in the 3s, and then we saw inflation like the next print was much higher than that. So those people are losing already when inflation is higher than their cost of living adjustment. Or if your raise, let's say you got a raise this year, your raise was 3%. And companies base raises off of these numbers as well, off of the inflation expectations. So they say that your raise was 3%, but then we see inflation running 4 or 5%. Did you even gain anything? Or even if inflation is at the same 3% that your pay rate increase was, are you even gaining anything? Perhaps you're even losing once the taxes come in. But more money, more problems, as they say, right? But it's not the same way that we're thinking about. Inflation is huge in productivity, economic growth. You have to know where we're sitting at inflation. That's why we just sat here and watched 45 minutes of Kevin Warsh's video. I've watched every Fed speech since Powell took office. I enjoy watching them, listening to what they're saying, ciphering out some of the noise so that I can decipher what is actually being said here on Main Street from Wall Street or from the Treasury. This is up in D.C. Or I guess that's from the Federal Reserve, not the Treasury, but the Treasury as well. Let's jump into quickly talk about SpaceX for a second here. So SpaceX had their IPO. SpaceX's IPO was one of the largest, I think it was the largest in history, actually. But SpaceX's IPO, whether we're not going to jump into the valuations and whether you should buy or whether you shouldn't, actually have like a couple videos on that if you want to go back and check out on the channel and a podcast. I mean, where you see the interviews from the SpaceX people, you hear them lay out their thesis. I mean, several hours of it are available on the channel if you want to listen, if you want to hear my thoughts on that. And also was quoted inside Business Insider speaking on SpaceX's IPO and its potential inside employees' retirement plans. With that being said, SpaceX's IPO, as we expected, was volatile, but it ended up for the week from its first price. I mean, its initial IPO price was $135, but it initially jumped right up to like 160s, 170s. And I believe last week it was up in the 200s, the low 200s, 220s, 230s maybe. But it came back down into the high hundreds, so $170 maybe, somewhere in that range. But that's what you're going to see with SpaceX and companies like these right now. So they're going to be volatile, extremely volatile. We have Anthropic and OpenAI coming out later this year, or OpenAI or later this year and beginning of next year. Several other IPOs are coming out. When you listen and you hear people think about IPOs, like I said before, David Snyder mentioned with the IPOs that 5 years later, they're usually down from your initial price where you buy them from. But that's because the way they're set up, IPOs. And this one's a little bit different. This isn't, once again, not an endorsement to buy SpaceX or to not buy SpaceX. That's your personal call. Some of my clients want SpaceX. Some of my clients do not want SpaceX. if you are going to buy SpaceX, or my personal philosophy with these clients, I just let them know, like, this stock could go in half from where we're at right now, from where that initial price offering came out, and it could do it fast. Or it could go, one question, it could go to 50 or 250. Which number is it going to hit first, right? $50 or $250. Which stock price will it hit first? We'll see. It's kind of like those things with Bitcoin. Same thing. Like, will Bitcoin hit 50,000 first or 250,000 first? You just don't know. It's that volatile, and SpaceX is kind of that volatile as well. But SpaceX does have a lot of different components that they're bringing in, and I think eventually you'll have Tesla brought inside of SpaceX, one huge mega company, because these market caps and valuations help Elon Musk reach his compensation package, which he set up, and they also help Elon Musk become the first trillionaire in history. The SpaceX IPO made a lot of people millionaires. And that's another example of like how IPOs work. So private credit people, if you're buying inside of a private credit entity or company like SpaceX, so their employees, for example, began working there, and they were probably getting lower like physical compensation dollars salary wise, but they probably had a lot of stock options or IPO options for that SpaceX private before it went public. And once Elon Musk and his team went on and did their roadshow with the bankers, so I think Goldman Sachs and Morgan Stanley led that effort. Once they went on their road shows and they were doing the tours with the banks and the bankers, explaining their strategy, those individuals had an opportunity to sell some of their stock pre-IPO, or they could hold them to when they went public. But once they go public, they're gated. So, you can't sell them until a certain amount of time. Usually these IPOs can't go into indexes for at least a year. They have to be profitable. I'm speaking of the S&P 500. They have to be profitable. They have to have earnings. NASDAQ fast-tracked the allowance of SpaceX in there, but NASDAQ also launched the SpaceX IPO. So that's one of the things I said is going to be different with the SpaceX IPO, or that is different. The SpaceX stock will go inside of the NASDAQ 100 index sooner than most stocks go into indexes. So they'll actually be inside of people indexes. So that'll push the price up a little bit. You would imagine the cult following of Elon Musk, I think they had announced they were going to allocate up to 30% to retail investors, but they ended up allocating maybe 20%, 23, 24% to retail investors that had very small float, like 3 or 4%. So very small amount of stock that was available for people to actually purchase. And like I said, the stock price didn't go extremely crazy that first day. Like, it went up, but it didn't. And to say like from 135 to 180 isn't extremely crazy, but we've seen stocks on those IPOs like double and triple, like just ridiculous numbers. And those things crash and destroy extremely hard. Not very long after that, we've seen it just here recently in history. And there's been a lot of markets for the IPO game. People really want to see IPOs again. We expect banks to benefit from IPOs. We expect individuals to gain from IPOs, but you also have to realize that people are hesitant with IPOs because the IPO has been looked at as a trap for retail investors. People assume that institutional investors, and rightly so, because this was a time where only the institutions were really making money on IPOs. They were catching the money as soon as it started. They had these options that I was speaking about, like with some of these employees, they were buying up these stocks and then they would sell them. So the retail investor had more exposure to the SpaceX IPO. I was in one of the Benzinga. I was in a Benzinga show in the chat with him. Shout out to Benzinga Pro, which will help actually right now. If we have less Fed guidance, you can check out Benzinga Pro for some of their research and market data. I'll have a link for them. I'll leave it in the description for this video. And people were talking about the amount of SpaceX shares they were getting from their pre-orders, like retail investors. So that was something different, because usually it's hard to fill those orders. People were getting half positions, but like a billionaire investor, Ron Barron, who's been investing with Elon Musk for a long time, I think he put in for $1 billion and he reached his full allocation. He got the full $1 billion allocation. So, and that was at the IPO day. So certain people, they got their full allocations, but it was interesting to see that I thought more was available at the beginning than it would have been as far as like what people were requesting. Some people were requesting 100 shares and got 100 shares in there. Also inside the IPO, SpaceX set it up where you have to, not SpaceX, I'm sorry, certain custodians set it up. So like Fidelity or other custodians had it where you can't sell the stock within a certain amount of time. If you try to sell it within 2 weeks or a month or something, because they don't want you to flip it, then you'll get like a restriction, a 30-day restriction, 60-day restriction, and the time's arbitrary. I'm paraphrasing here, but So 30 day, 60 day, and then like I think after the second or third time, you may be restricted from ever participating in IPOs again, because that was one of the things we worry about, or that retail investors would take these IPOs and just try to flip. Whereas I guess, quote unquote, air quotes for anyone listening, institutional investors tend to hold on to these positions longer. So when they're holding on to these positions longer, that gives the stock more time to find its footing and its balance, and also gives more time. If you ask retail investors or people who say IPOs are a fool's game, that gives more time for people to come in and be the last man without a cheer when the music stops playing. I don't know. We'll see. Once again, inside that, so you also have the allocation to the retail investors, which is different. Then you have Elon Musk and the cult personality and cult following that he has. So he's one of the original Tesla's, one of the original retail investors market. We saw a lot of people. So he has a built-in base of people who will buy stock, but not enough people to support a stock forever, right? Not enough people to support that stock at that level. But as the stock goes in the indexes, that will force institutions who own these indexes, these are going into pensions, these are going into hedge funds, people who they'll be including SpaceX, and then they're fund managers. So when I say a fund manager, someone who creates their own portfolio of stocks and they sell them out to people. You invest in this and they'll show you my fund has performed versus the S&P or XYZ or whatever stock index. XYZ is not stock index. S&P, Dow Jones, Kashi, you probably won't compare it to Kashi. That's an international stock now. But any index you want to compare it to, and you pick individual positions and they build out portfolio. But if they're doing that to mirror the NASDAQ, if that's the portfolio that you've put into mirror, then you have to include some SpaceX stock in there. So people will be buying SpaceX stock if they have to fill it up. Another thing that happened earlier than usual were the options came out on SpaceX. So we saw a lot of volatility with options. Those calls and puts were priced extremely high for options calls for people who've never bought options. Be careful if you do buy options. Options are tricky, man. Options are hard with timing, I'll tell you that. Be careful with options, all right? If you're going to buy options, you need to go do some research, like some deep research on options. You need to have a entry point and an exit point with options, because options will leave you with zero if you're not careful. Be careful with options. But the SpaceX options came out last week, so traders were trading them as well. So the speed, the fan base, the actual individual involved with SpaceX, all these things make SpaceX's IPO different. We also saw leading up to the SpaceX IPO that shift in crypto, the flush out from Bitcoin, but it's also a Bitcoin winner. So people don't know if it's just a cycle with Bitcoin or if it's also the timing. We saw some of the high flying tech stocks lose a lot of market capitalization. So a lot of money went out of them back into the stock market. We saw the stock market actually go down, have some rough sessions there with the Dow Jones here in the last few weeks, and the NASDAQ and S&P. It's been a couple dead cat bounces inside there, where it looks like the market wants to pull higher, but we're still hovering around all-time highs. Watch for oil. I'm still inside the IPO, but I'm sorry, it's going to step out a little bit outside, because we're, setting up just let people know what to watch for. Like, we saw the mechanics where oil prices were going down and stock prices were going up. That's good. That's how it's supposed to be like, right? If the stock movement was based on the war before, like, so when we saw in February, we saw stock prices drop. Initially, we saw oil prices go down. Then we saw a period where we saw oil prices going up and the stock market going up. That wasn't really, I don't know. We did have strong earnings. Earnings are what should be driving the stock market. One of the things that should be more influential on the stock market are stocks, or whether they're actual earnings and where they're actually producing results, how they're taking this money. We've seen this apocalypse system. We've seen a lot of companies say that they're now sourcing out debt. So we can't say that's all the war or all Cameron Warsh or all IPOs that cause money to move out in the markets, but there were definitely people preparing to get their dry powder, quote unquote, cash ready to buy some of these IPOs. And they're still waiting on more IPOs to buy in the future. People also realize that this market is bumpy right now, so there will be opportunities to come in and buy the market. One thing that I want people to realize, and whether it's investor or trading, sometimes the best move is no move at all. Like, sometimes the best buy is not to buy or to sell, it's to hold tight with the position that you already have and just figure out where it's at, figure out why it made that move, figure out what happened inside that stock. So I want to take a second here, if you're listening, if you're watching, if you get some value from this, share this with someone you love, someone who needs to hear this. We recently just sat down with a lot of great conversations. Brad Olson over at Benzinga, I've been sitting down in the chat. Well, I got some great ones coming out with Derek McKinley. Derek Kinley, he sold his financial plan firm for an 8-figure exit. We did the Broke series over there with the LinkedIn editor, John Tomasi. That's really great. With first we talked about sports, so we talked about the Knicks and Spurs. Shout out to the Knicks. Shout out to the Hurricanes down here in the Wall Street South. It's just great content. There's a lot of great content. If you don't know the tempo of this channel, is this your first time watching? I love to help Main Street meet Wall Street, but I can't do that alone. I need your help. I need you all to share this stuff, subscribe, like, engage with the content. If you leave a comment, I'll comment back. I'll reach back out to you. But this is a free pipeline for people who they don't know where to start. They hear this jargon and they're confused by what these people are even talking about. We need information as such a powerful tool, such a powerful weapon. We need more of it spread out throughout all the people who aren't paying attention to these type of things, whether it's due to a lack of knowledge, a lack of time, or a lack of desire. Like, these things impact your wallet. At the end of the day, your standard of living, your cost of living, all these things are intertwined. So that's what I'm doing over here on Main Street meets Wall Street. I'm trying to help people have the ability to digest, evaluate, and make informed financial decisions. So hit the like button, subscribe. If you're listening on podcasts, give it a 5-star review. Just join the channel if you enjoy this content. Tuesdays are going to be, we're always dropping the podcast with the guest on there. That's Tuesdays, usually premiering in between the 9 and 10 p.m. hours somewhere on Tuesdays. And then Saturdays, we usually drop something as well. So it's something like this, a series where we're just speaking on what just happened in the world and in the markets. And also we'll probably start doing a pre-week of setup. So help people set up for the week that's coming ahead. But back to IPOs. As I was saying, the SpaceX IPO is different. I think it set up a structure where now we will see other IPOs that are coming out adopt this structure from the SpaceX, where you have a certain amount, you have the price set where retail or more investors can access it. You have a certain allocation put out to retail, because Anthropic, OpenAI, these are also companies that are going to be highly pushed by retail investors as well. Another thing we saw in the markets this week, we saw the move back to some of the memory companies, but we saw a broadening of the stock market. But it was just a very volatile week inside of the market. As we've seen here recently, we're going to continue to see choppiness. We had the memorandum, the peace memorandum that was signed, but then yesterday they were supposed to meet up. So Friday they were supposed to meet up and officially sign it, and that trip was called off or postponed. We'll see where that leads to. That is a very fluid and dynamic situation, but Main Street, we have to stay informed. We have to get these tools. We have to gain and understand some of the things that the world is presenting right now and how it impacts our money. Like I was speaking earlier, we were talking about how folks are important, how folks are placed. We were talking about Fed chairs. I was talking about Kevin Warsh. That's a result of our vote. So go out and vote, because that's one of the main powerful tools that you have. We didn't vote for Warsh, but we voted for, or the world, however you want to look at it. We're not getting political here. The administration that's in office gets to make that decision based on the votes. And then the people inside of Congress, so you have the Senate and the House of Representatives, they actually have to confirm these people into these positions. So once again, impacts of our vote. So just remember that. We're sitting here with the 2-track economy. We got markets versus households. As we sit here, we see, how can this S&P 500 trade at record levels, right? How is it trading at record levels when consumers are struggling at home? And it shows the divergence where we're at right now. In this case, you have the economy. Like, the personal savings rate is really low, I think like 2.5%, suggesting consumers tapped out. Or is it a sign of extreme confidence that we can spend money? I think affordability is really hitting people in pressures. Small businesses, they're signaling that, what are the small businesses telling us? There's been a low hire, low fire, but there's been steady job growth, inside of our economy. And the wealth effect, is the wealth effect continuing to carry this? Are stocks the reason that people are able to live with this higher cost of living? Because once again, like I said, stocks and higher inflation, who's going to win out in the long run? Historically, stocks have outperformed inflation in the long run. And then, well, the rates, what are we going to do with rates? Are rates going up, rates going higher? One thing to watch with rates, so you can listen to what the Fed chair is saying, as you should. I don't say listen to what he's saying as you should for particularly to agree with him or disagree with him. Saying listen to the words he's saying, but also watch what the actual bonds are doing, right? So watch what the bond rates are doing on the other side. Are they going up? And when I say bond rates, I mean U.S. Treasury rates, so like the 2-year, the 10-year, the 20-year. See what they're doing. Are they going up? Are they going down? If they're going up, chances are that means that they're not. If the bond rates are going up when the Fed chair said that they were looking at rates going down, which Warsh didn't say. Warsh didn't say he was lowering rates, which was also interesting. That means that the bond market expects rates to be higher, right? If they're going down, that means eventually the bond market expects rates to be lower. Bond market wants to play it pretty close. The spread, look at the spread from how much you're paying for these U.S. bonds versus if you go out and buy a corporate bond. That corporate bond should give you a higher coupon because you're taking more risk lending your money, because a bond is up, that's what you're doing. You're lending your money to someone and they're paying you an interest rate coupon back for, usually biannually. And with this coupon, and at the end of that term, you get your money back, plus whatever payments you made. The coupon is just a loan, whereas if you own a stock, you actually own part of the company, equity, you own it. It's a part of the company that you own. Sometimes they pay a dividend, not a coupon, but a dividend, so a percentage on their earnings. Sometimes they don't. Sometimes you're in there for the growth. But just something to remember when you're thinking that. And then another big thing, what is that Chairman Warsh mentioned that it's 2%, and that it's on the left side of the decimals where he's really focused on. So left side of decimal versus, where we're at right now. It's going to be a big week coming up. It seems like every week's going to be a big week, just where we're going, just with the market, with the world, the war in Iran right now, that conflict and the Hormuz paradox. I mean, how is it going to affect your fuel costs? I noticed that fuel costs are coming down. I haven't checked them today. I need to check the fuel costs today because you can see it daily down here where I live. Like we can see it go up, we can see it go down. But will this spike in fuel costs from the last month create sticky inflation, or that won't disappear even if these tankers move? They've slowed down as of right now. The traffic has slowed down. Are markets really underestimating the second order effect of this conflict on global food and fertilizer logistics? Growing season. And then, why is this geopolitical shock? Is it structurally different from the 2022 energy crisis when Ukraine and Russia began their war? Like, how do investors differentiate between a war-driven supply shock and a true recessionary trend in energy demand? Then you have the war, and this conflict picks back up over the weekend, which just shows that you have to stay in the market. You can't try to jump in and out of the market. You can't try to time the market. It's not saying you don't lock in some of your gains. You should lock in some of your gains. You need to trim some of your winners when you have the opportunity. Not every day, maybe quarterly, maybe biannually, maybe annually, whatever your horizon is. And it depends on when you retire or if you're retired as to how often you want to go in there and even rebalance anyway. But these are opportunities to reevaluate where your position is, why you're invested the way you are invested, what your actual investment themes are, what's your philosophy. Why am I invested in, and this is not a recommendation or this is just an arbitrary stop. Why am I invested in, let's say, ExxonMobil? Okay, yeah. The war started, I'll go out and buy a bunch of Exxon. Full disclosure, I've had clients in Exxon way before the war started. But say the war started and I didn't buy any more when the war started. But let's say the war started and you say, okay, I'm going to buy energy now because gas prices are going to go up. So you went out and bought some Exxon to add to your portfolio. And now you think that the war is going to end, or you see oil prices coming down, you see stock price move. Is this a time for you to sell Exxon? I don't know. Did you buy Exxon solely because you wanted it for the war? If so, then maybe it is time for you to trim Exxon. But you also have to think about the time you hold these stocks. So a lot of people don't take that into account. And I'm going on a rant a little bit. I'm sorry. Like they'll trade and they'll make a huge gain in a stock. They'll make 100%, but they'll forget that 40% of that's going to be taxed if you sell it quick. So you really only made 60%, which don't get me wrong, that's a nice percentage, but you have to take that into your calculations. So whether you hold it over a year and a day, as they say, that turns into a long-term capital gain versus a short-term capital gain. And that drastically drops your tax rate that you pay on that sale that you have there. So I always like to I like to do research and study companies, but I always like to go into an investment or a trade with at least a 1-year horizon on anything that I'm investing in. And notice that I said investing because not trading, we're investing. If you're going to trade, make sure you got like some outside account that you can do it with a minute amount of money. You know, some people do have that trading itch, but be prepared for taxes. People don't think about taxes. I remember that was a big thing with the Bitcoin run that we had and the meme trade, the GameStop. People were underestimating the cost of taxes, and it was just people were upset. So I guess some big questions here are what will be the results of this task force? You know, how will the Fed moving away from forward guidance impact retail investors? Are they going to continue to guess now based on these press conferences, or are they going to really just start analyzing hard data with tools like Benzinga Pro? Or, you know, how are retail investors or people who don't have access to these meetings that they have or backdoor channels going to invest? And this Warsh stance that the Fed has less control over prices than previously before represent a pivot to a more handoff monetary regime. It seemed like Warsh wants the markets to churn and work for themselves and the Fed to play its role. It's interesting that he did not push for lowering rates. I think he sees where we're at. He sees we're at a point where you don't have a strong case right now for lowering rates at any cost. And the next move may have to be an actual rate hike. We'll see. Depends on how persistent this inflation is and how growth is going. If we continue growing this economy as high as predicted, you know, is this current AI bubble still being fueled by what many have called, air quotes for those listening, circular financing, or are we seeing general capital expenditure returns? We've seen companies announce just as recently as last week that now they're going out into the debt markets. Companies with, I mean, some of the largest companies in the world, so companies with large amounts of free cash flow, they're going into debt to fund some of these AI build outs. Are we going to build data centers in space? I don't know. It's another SpaceX play. If they do, I heard, I think it was Peter Thiel maybe came out with the idea of putting data centers in water. Once again, I definitely ain't drinking water from the ocean, but think about that, man. But that's just something else I do, right? I guess all water comes from the ocean eventually, but think about the things you want to put in the ocean. That's a whole nother thing. And, you know, Benzinga Pro, like I said, it can help you if you take a second and look and give you some of this new data, see what some of these signals may be, especially without these new channels. And there are companies like Micron and Dell. Are they now picks and shovel winners, or are they just the latest high frequency momentum memory play in the case of like Micron, or, you know, Dell's another American champion? We saw Intel and Apple just announce something, or maybe the administration announced it. I don't even know if Intel and Apple announced it. We saw Intel price shoot up again. So what happens to free risk assets of the US dollar when the government borrowing cost accelerates, or like non-linear, right? So if the amount that we're spending really exceeds our amount of debt, or if these interest rates don't come down, because that has a lot to do with how we finance the debt too. Is this current market rally that we've seen sustainable if the Treasury's most continuously issued record amount of debt, you know, continues to cover this deficit? What are some of the risks of this fiscal dominance, where the Fed feels pressure to hold rates lower than inflation to monetize the debt? So that's what I was saying, like, if we keep these rates lower, it's going to help them with paying off the debt, but there's just a lot to go inside of our debt right now. And if you want, I have a couple hours of video on debt as well. If you want to go check it out on the channel with Mr. James Callahan, who was a debt analyst for many years. We go deep into the debt, at that time it was like 36 trillion, how it was actually like $160 trillion serviceable debts. Those numbers are higher now. That was a couple months ago. But like I said, this is an outlet for anyone who wants to learn pretty much anything financial. We have something covered. We go from 50,000 feet to the basic building blocks on some of the videos as to, you know, setting up emergency funds, and which, you know, you need to set up an emergency fund. That's one of the first things you need to do. But obviously you have to have a budget. You need to figure out your debt, figure out a method of paying off the debt. But emergency funds first, right? You got to pay yourself. You got to get that savings rate. Just several things into like stocks versus ETFs versus mutual funds. Never making stock recommendations on this channel, because everyone's portfolio is different, right? If you're listening to a channel or somewhere and they're just making a recommendation, go buy this. I mean, and that stock might go way up in the time that you're talking about in a short time, but they're probably not for the 80-year-old person listening to this, or the person who's about to retire. Not the stocks that most people are talking about on the internet or whatever. Those are stocks that are going to be up and down, like SpaceX, volatile stocks that you can't particularly have in your portfolio, or you can't have an oversized position in your portfolio if you're about to retire. If you're a longer term investor, like I said, how does these volatile mid-cycle environmental changes, like how are you allocating that high beta, so high risk stock inside your portfolio? And then modern portfolio theory, I spoke about that a little bit with Benzinga's chief content officer, Brad Olson. And is it being replaced? Like, is the 60-40 being replaced? Modern portfolio theory focuses on a lot of things, correlations. It had a lot to do with so it was part of the reason why people invested internationally versus domestically, where you had that mix. But it's a lot of it about diversification, correlation, and how if you have the proper amount of diversification, correlation, and you reach out to a efficient frontier, that you'll have the best performance that you have, your optimal performance. And then, how can you perform a weekend stress test? These 3-day weekends are always, or recently, have been interesting, right? So you see a lot of people making moves going into these weekends, and you'll definitely see some moves coming out of them. And why is it important to track these institutional flows? And what the Fed is saying, I'm telling you, we need to pay attention, right? We need to pay attention. We got personal consumption numbers coming out. There's always data coming out, right? And once again, you can check out Benzinga Pro when the Fed drops this data, or when there's something that comes out that people don't quite understand. There will be a link down in the description for it where you can just take a look and see some unusual options activities. Be careful with options, institutional flows, and real-time news, probably before it hits the headlines. Those guys are on top of it. I will give them their credit, give them their flowers, as they say, to Brad and the team over at Benzinga. They're just really doing big things over there, and they're making great moves. We've been talking for a while, so we had Chairman Warsh come on, give his speech, and let him speak for a while, 45 minutes of that. And I've just been kind of riffing and speaking on the IPOs and the Fed, inflation, jobs, just sitting here talking to you, Main Street. For those of you listening, hit the like button, share this, subscribe. Also, anyone who wants to do budgeting, if you're struggling with your budget or personal budgeting, check out Modern Money. I have an affiliate link for them. I can leave in the tools. They don't do any selling. There's no ads in Modern Money. Or Money uses AI to help you as well. You can share it with people. You can share it with your spouse or whoever else you're budgeting with. You can share it with your financial advisor or financial planner, someone like myself. So yeah, there's just a lot going on right now in this world, and these are tools that can help you. And that's not to say that and with those tools, yeah, I guess I should say those are going to be affiliate links, so the Benzinga Pro and the Monarch Money. So if you do happen to use those, I can or may receive a commission if you use those links that I said, or a fee if you use the links that I said. I want to get that full disclosure, and those are tools I've definitely checked out and used myself. So get that out there so people know. We need to be informed. We need to make informed decisions. We need to know what we're looking at. We need to know what we're listening to. I've really heard a lot of people lately they're listening to all these gurus, all these people who are just saying all type of, it's ridiculous some of the things that you're hearing out here in the world today, as far as what people are saying. I hear, and what you have to notice is that these people making these outrageous claims, there's no accountability really for them, other than if the SEC or FCC or someone like that came in and got them. But as far as from everyday people, there's no accountability. They're not licensed or insured or bonded to really make these so that's why you don't generally hear financial advisors or financial pros hop on video and hop on YouTube and say things like, go about this and you'll get a million gazillion. We're not going to say the word guarantee, really, rarely, because nothing's guaranteed. Few things are guaranteed, I should say. Death and taxes are guaranteed, but few things are guaranteed inside life. So please, you have to understand, and the difference is another few differences. I'm just making a plea for people who, and this is whether you're dealing with mental health professionals, financial professionals, any type of professional you're dealing with. I've seen people charging, I don't even want to say the numbers, but just ridiculous amount of money for courses, and then they're offering basic stuff. They're offering stuff that you definitely can get on this channel right here for free. But anyway, they're offering all kind of, and not just my channel. Like I said, there are other channels, other people that you can listen to and watch where you can get this information. I don't want to say the same information because, it's a little bit different over here. Main Street meets Wall Street. We do a little bit different over here, but you can definitely go out and get great information. And also, folks, always remember, like, have different sources for information. It doesn't have to just be one person. It's fine. If the person you're talking to gets offended because you ask them a question or you ask them about some information, I mean, what? That's probably on them. That's probably more of a telling sign on them than it is on anyone or anything else. But yeah, so as licensed professionals, we have insurance, bonds, insurance. So if something was to go wrong, we mess something up. We're doing continuing education, so we're continuing to grow and learn. We have to take tests, the certifications to meet federal, state. We have to meet certain information requirements. So we have to have certain knowledge about things, right? Because like I said, anyone could have said, and this isn't taking shots at people, anyone could have said, go buy NVIDIA in 2023, and you would have made a lot of money if you would just held it a year or whatever, when it was trading, it was going through all-time highs, when it was becoming an all-time, or when it was becoming the most valuable company in the world. But it went down those times too. What to do in those situations? What's really your risk tolerance? Are you really investing at a proper risk tolerance for your age, for what your long-term goals are? What's the tax consequences? What's the whole picture? And how much of this should you have, right? Everyone probably should have some NVIDIA, but guess what? Once again, that's a stock that's inside an index, so you will have it. Once again, not stock recommendations, but how much of this particular stock should you have? Am I getting these stocks already inside of my employment plan? If I work in one of these big companies, I work on Microsoft, Apple, Lowe's, these are companies that are all around here in the Wall Street South. That's why I just said, that's why I'm mentioning these companies, because I know a lot of people work down here and they offer stock and incentives to their employees. So you have to think about these things as well when it comes to, like I said, once again, when investing, are you investing? Is it going to be over a year and a day? Like, and that's still short-term investing. We speak about investing, it's still short-term. Or is it a long-term hold? You know, am I buying this and I'm going to hold it, never sell it? Maybe I think that's what Ron Barron said about his SpaceX. He said he's never selling. But we'll see. You know, never is a big word. Never is as big of a word as guaranteed with financial professionals and in the world that I live in. But once again, so I've seen a lot of different things in this world. And that's not to say that people who are doing these things or saying these things aren't actually being effective and efficient. I don't know if you ever heard of the book Think Rich and Grow, or Grow and Think Rich. That may be the name of. They're actually two different books. One, Napoleon Hill wrote it, and he's questionable about whether the information he wrote about is true. He said he once spoke to Carnegie, maybe I think it was Carnegie, one of the Gilded Age millionaires and people who were so rich back in the day that didn't even. It was ridiculous. Like Elon Musk rich right now. But went back and he said this man wanted to write a book about his thoughts, how he got rich. I actually have read the Think Rich and Grow. No, I did that audio. I listened to that audio. Think Rich and Grow. But it's very interesting. But it came out later. It's been questioned as to whether he actually even had those interviews. Actually, as whether they were even actually happened. The person he was interviewing, Carnegie, has written plenty of biographies itself. So people are like, Carnegie probably didn't need a biography. There's just a lot of different things that question whether or not Napoleon Hill's book actually was based on, whether it was a nonfiction or whether it was kind of a fiction. But at the end of the day, his book has inspired so many people to go out and do things and grow. They've grown rich. Like, I think Tony Robbins is quoting him, that some of these big people that you hear right now, some of these big inspirational speakers, it all ties back to Napoleon Hill. So whether he was grifting or not, his work got results, right? And I don't know if sometimes in there you're gonna get bad results, sometimes you're gonna get good results. So that's to say, like, someone like that. Or then if you even think about, like, let's say Richard Simmons. You know, Richard Simmons came in, he was dancing. His message was health and fitness. I don't think Richard Simmons was a personal trainer, certified personal trainer or anything, but he went out, he got people to take action. Dave Ramsey, you look at Dave Ramsey, people, you know, that's a really hot topic. People either like Dave Ramsey, they're against Dave Ramsey. Dave Ramsey has some interesting theories and some interesting topics, some interesting statements. Like he was saying, the stock market's 10% return historically. That's a little high. But Dave Ramsey gets people to take massive actions. He's helped millions of people like start going down that financial path, for better or for worse. I don't even say for better or for worse, because the moves he helps people to make to begin, if you're just starting out, Dave Ramsey is going to help you starting out, getting down the path. I can say that, like, with the things he's going to tell you, he'll help you focus on budgeting and this. Like, some of that streams he goes to, like, in my opinion, it works for some people, like paying off all your mortgage and all that debt. Like, I don't know, get that some time, but definitely gets people focused. That envelope method, if you're just starting, for anyone who hasn't, where you take all your cash and you put your actual cash into envelopes. And that's what you get to spend for each bill. So if your power bill is $100, you put $100 in that envelope for power. You put $100 in leisure. You put $100 for savings, or whatever. And once you run out of that money for that allocation, then you either don't do what you have. So if you spend that $100 for entertainment before your next month or next pay period or whenever it is that you budgeted for, then you don't do any more entertainment. Or you have to take it from somewhere else out of those envelopes and put it into that envelope so you can do it. But you have a finite amount in those envelopes, and you have to figure out how to make it work. And those type of mental exercises help people out. Like his Financial Peace University, I've never taken. I read one of his books. People seem to find value and people make moves from what Dave Ramsey tells them. So that's just another example. So then we go into, and it's a community like, I don't know if people can afford these programs that are out here now. And there's plenty of people on the internet bashing them and attacking them and saying whether they're good, whether they're bad. That's not what I'm saying, where these programs are good or bad. I'm saying they're helping people take action right now. A lot of people who have never taken action. And hopefully once these people begin to take action, they begin to go deeper into their research. A good thing that you can do is never just look at one viewpoint for research. Always fact check it, trust but verify. Feel free to look at another person's information from what they're telling you, right? If they're telling you this and they're telling you, I heard a popular statement the other day on a show. I tuned in to watch someone else that I'd never seen it. It was one of these money podcasts or episodes. I'd never seen it. I heard people talk about it. So, and this channel has millions of subscribers. Tuned in to watch it, and I heard one of the hosts make a statement about Micron. He said Micron's capital, or Micron's Micron's market cap went from 500 billion to 1 trillion. And he said in 48 hours, fastest ever. It did have the fastest ever from 500 billion to 100 trillion. I meant from 500 billion to 1 trillion. But it was not 48 hours. And someone else on the show questioned. They said, oh, you sure it was 48 hours? It was 48 days, which is still extremely fast. Like, that's fast. But it's nowhere as fast as 48 hours. And that is a material mistake that someone probably should correct it. No one did. But those are the type of things like no one's paying attention to, I guess. They just see the movement and see the price. Because if you were in that stock, Micron, I think Micron was the stock. Like if you were in Micron at the end of March or in March when it got down to in the high threes, and now Micron's sitting at $1,100, yeah, you were like, oh, I got, but once again, when you're getting out, when you're trimming, what's the taxes? Are you in this long term, short term? These are kind of things that you need to look back and figure out when you're investing and when you're working with people. So some of these courses that people are offering, just, I don't know, they're interesting. But I do love the fact that people are having conversations. People are learning different things, learning different topics. Just go back and research what you're hearing, especially if something sounds like extravagant. If something sounds extremely extravagant, you need to go back and check back on that. Let's go back and look and see like what we're really doing, like what's really happening here, what are we really talking about. So I'm trying to think of another example with people who get results, but I don't know. You have to just look and see who you're listening to and check. Make sure these people know what they're talking about. Are they experts on the subject? What makes them an expert on the subject? Did they just happen to buy some Bitcoin at 5,000 and it went to 100,000? Did they sell it? They still have it? No. What are you doing right now? Because another thing is a lot of these folks don't show you their investments. They don't show when they go up or when they go down. They may make a trade. They may hedge the trade where part of the trade, they may make the same trade, a call or option trade. So a call bullish meaning they think the stock's going to go up, and a put, which is bearish, meaning they think the stock's going to go down. They may make the same trade for the same amount on both sides, straddled. So if it goes up, it looks like they would make a lot of money that way. But if it goes down, but if it goes up and they got the same bet that it goes down, they lose money on the other side, and they just show you one side of the trade. So it's just like something that's a whole lot. So like total returns, watch for these type of things, and then just be careful in general on Main Street. Like I said, this is an outlet. Hopefully people can sit back, take in different information, learn about what's happening and what's going on in the world. We have coming up this week on the podcast, we have Derek Kinney's episode coming out. It's great for anyone who wants to learn how to speak about what you do, how to Market Yourself, he tells a great story about how he got involved in local schools and how it really grew his business. Like I said, Derek has sold his business. He sold his business for 8 figures. So I think he knows what he's talking about. He wrote a book. He's out doing his book tour right now. We spoke with Brad Olson from Bazinga, Chief Content Officer. So Brad's great. It was a great conversation. Check that one out. So all this is on the YouTube channel and the podcast. We have some live sessions coming up with Mr. Stephen Davenport and Samuel. We're bringing Samuel back. Me and Samuel want to sit down and chop it up from Business Insider. So there's just a lot coming up, not to mention some of the great podcast things that are coming up. We got the crypto stuff coming up soon. The other side of the bullish case. We had a lot of crypto bears. Me and Clem Miller went down that crypto hole where he made the bear case why Bitcoin is a fraud in his opinion. So I want to bring different opinions. I want to bring people on here who you get the facts from their side, this side. You can go check them out. You can go check out and do your own research. I'm not going to tell you to go buy this stock or not buy this stock. I can tell you if we ever talk about a stock or a sector, why this stock or this sector has the pros and the cons, So just another a lot of stuff going on here. If you can't find the plug, just like with the Wall Street South Journal, that's up almost to 1,400 subscribers. We just launched that in February. And in the initial edition of that, I said, couldn't find a table, so I built my own table. That was the first part of the table. And guess what? The table was getting big. Everyone, there's room at this table here. We're letting you at the table. If not, we're going to show you how to build your own table. Couldn't get plugged in the proper way, so we're building an outlet. This channel is the outlet. Main Street meets Wall Street. Like if you want to learn information without all the jargon, we have the fancy jargon. Like I said, that's usually going to be probably a Tuesday episode. We're going to give you some of that, but on Saturdays we pull it back a little bit more. Check out the hair. You also like the hair pulled back, just a little bit laid back. Just laid back. We're still giving valuable information, practical tools, and steps that you can take and make every day. Got a lot of great information, a lot of great content coming out for everyone. Like I said, Main Street Meets Wall Street podcast is on fire for those who haven't seen it. Just a lot of big things coming out. I hope people take the time to really check it out and see how we're helping Main Street meet Wall Street. Also, just to recap, in this video, we've talked about Kevin Warsh and his new moves, how it's going to affect and impact. We let you hear it from his own mouth. Warsh speaks. And then we also spoke about, IPOs, mainly the SpaceX IPO. We dug deeper into that one. And then just what we're looking for this week. There's a lot of consternation moving forward. We don't know where interest rates will be, where the war will be. Well, interest rates are holding steady. So we know where they're at until the next 6 weeks when the meeting happens again. I guess 5.5 weeks now. But we've covered a lot of ground because there's a lot of things happening in the market. If you found some value in this, hit subscribe, hit like, share this with someone. This is the epitome of Main Street Heart meets Wall Street Smarts. That's what we're trying to do here. We really cover those the 5 task forces for the Fed. So communication, that balance sheet audit, economic data sources, so those models, AI and productivity framework, and then trying to reach that inflation target is the two really feasible. They all were committed to reaching that 2% inflation target as they have been. So it's good to see uniformity inside of that group, at least on one subject. But you do need a little pushback both ways to actually get your best result. You don't want everyone all agreeing with the chair, everyone all disagreeing with the chair. We need some lively conversations from both sides of the table, and we need people to articulate and research and evaluate and deliver to the American people the best result for price stability and full employment. I know Chairman Warsh didn't really mention full employment, but that's what's in the amendment that created the Fed. That's part of their dual mandate. So, yeah, when it was created. So, Main Street Heart, Wall Street Smarts, hit subscribe, hit like, share this content with someone else, someone who needs to hear it, someone who wants to hear it, someone you love, someone you care about, or someone who's just asked these questions out loud. What does this stuff mean? What are these people talking about? Why do I care about interest rates? These are the questions that not only this outlet and this channel will help you find, but you'll also get it with unfiltered, no political biases here. Like I said, that video showed a lot of political ads, but that's just because it's that time of year. None of those ads are for me. It's that time of year. So remember to vote. I'm not going to tell you who to vote for. Just vote. Do research before you vote, too. Don't just go blindly vote. That's silly. But Main Street Heart meets Wall Street Smarts. Thanks for tuning in. Spend some time with me. Share this with someone. Hit subscribe. We'll see you next time.